Good evening, everyone. I welcome you all to Carnelian's quarterly catch-up. Interesting times ahead is keeping everyone on their toes. So, what's next from you? Let's have our founder, Vikas Khemani, share his thoughts on the same with us. Over to you, Vikas.
Thank you, Viraj. Good afternoon, everyone. Thank you for joining us this afternoon. I do look forward for our quarterly conversation where we, of course, share our view about what's happening. This is our regular interaction with all of you. So, of course, we share our view, but also I equally look forward to hear from each of you, about your view, perspective, suggestion, observations. So, like every time, we have kind of put together our thoughts on so far, what has happened, what's happening, how are we seeing uh, markets, what's happening with our portfolios. Feel free to ask any questions and any suggestion. So yeah, with that, I think of course, right now market mood is, I'm sure, reasonably positive than what we did about a quarter ago. Of course, it was getting better, but I think, of course, right now we are very close to all-time high, and hopefully we'll cross, very soon the new high. So environment has changed, mood has changed, of course, led by and we have seen good news coming by. India exceeded the GDP expectation. GST collection continues to remain very strong. So I think on all counts, things have been kind of positively moving. So and let's look at what has happened in like last sort of a quarter or so. Most important thing, we all know that earning which we keep looking for. So some of the things which we have seen, how it panned out in this quarter. If you see about a quarter or two quarter ago, there was a huge amount of sort of skepticism. We had SVB crisis, which had kind of created clouds on what could be the contagion effect. Then we had US debt ceiling crisis. So I think there are always worries keeps figuring out around the surface. But eventually, what we believe that we have to see what's happening in India, what's happening to Indian earning growth, what's happening to Indian drivers of the growth, and that is what we are going to talk about. And anything that we believe that market sort of returns, investing centers around three things: earnings, liquidity, and valuation. And on each of this, we will talk about in our conversation today, which will help you build some perspective about where are we and where we can go from here. So let us look at what happened in Q4 from earnings point of view. Nifty 50 earnings, there was very huge amount of skepticism as most of the participants got into the earnings season, and so of course there was a positive surprise across the board. Most of the sectors, Nifty earnings YOY grew for the Q4 for 19%, whereas the expectation was about 12%. So a massive 7% positive surprise to the markets on the quarterly earnings, so which is, I think, good news. And good news was also that it was pretty much widespread out, so it was not centered around one or two sectors, and that speaks volumes about various sort of factors at work. So let us see each of the sort of segments, what happened in each of these. Banks, as most of you would know, are in their one of their best growth phase. Their balance sheets are well provided for against any kind of NPAs, well capitalized for growth. There are no overhangs in the banking sector, and I can tell you this is one of those few times where I've seen no overhang around either on the balance sheet quality or on the growth or on the sort of liquidity. It's, I think, one of the kind of Goldilocks scenarios, so which we saw reflecting in the earnings of most of the or all the banks. I don't see any bank which is kind of disappointed. So that was very good. Credit growth continues to remain very robust. We saw almost 15% YOY growth across the board in the credit, which is a very healthy sign because most of, we started seeing credit growth only last 1.5 years specifically, and it's the early stage of the credit growth cycle. As the investment cycle picks up, as the economic progress happens, this will continue to remain robust. Retail MSME again continue to within this overall credit growth. Retail and SME reported very strong growth, which again is a very healthy sign. So banks by and large came out with reasonably good healthy report card. Second sector where most amount of skepticism in last 4 or 5 quarters have been around information technology, IT sector. We've been bullish throughout the year, even last 2 years on the sector. And if you see, none of these companies reported any slowdown of the order intake, despite talks of slowdown in US, recession in US. So I think all IT companies reported very good numbers. I think Infosys, there was a little bit of aberration, but I think that is more an aberration than really. I'm reasonably sure there's no structural thing on that, and stock has come back again post quarterly blip. So, and most small and mid cap companies have sort of given reasonably good growth than the larger companies, and that clearly also shows that the smaller companies are also in a very different phase of growth. And one thing, if you see across most of the smaller companies, many of those companies have got CEOs from the larger companies who have handled $5 billion business, $2 billion business, and I mean, Gensar had one, Birla Soft had one, Sonata, of course, had a couple of quarters ago. We had Eclux recently announcing new CEO. Tech Mahindra has just announced a new CEO. So I think we are seeing a leadership transition happening. So smaller companies are getting people, leaders from the larger company, which can leapfrog the company into next. So obviously, this clearly shows that what's happening in the IT sector, what is the potential. Deal wins continues to remain robust. And that's a great news in that sense. Interesting part in IT which has happened is the drop in the attrition, right? There was a period when attrition was crazily high. Industry never saw this kind of attrition post-pandemic, specifically in the calendar 21, and that kind of took a toll on the margins of the IT companies. And that was a time which coincided with a huge boom in the new tech, which took away a lot of talent at a crazy cost. That subsided as the new tech euphoria comes down, and that subsided. Pressure on the talent came down, and most of the IT companies are kind of in a reasonably good spot. Margins are solid. Earning growth is solid. Cash flow is solid. Dividend yield on most IT companies are in the range of 3 to 5%, depending on which company you look at. So I think it's a sector which we continue to remain very positive about. Automobiles and auto anchs, right? Again, stable domestic demand, exports recovered, reasonably well. PV segment is witnessing good demand traction. Most of the OEMs have been launching new models, and there's of course pent-up demand which is there in the economy. So we are seeing across the board reasonably good numbers, and that we think is likely to continue. Manufacturing sector, which we've been talking a lot about over the last couple of years, and we continue to remain. Most manufacturing companies, capital goods, electronics, water, EPC companies, everywhere you are seeing reasonable good traction happening. Of course, there are some pockets where, where we had disappointment, but broader scale, I think we have seen, manufacturing moving in the right direction, and that speaks volume again about the potential of this sector. Chemicals is the one sector we specifically chose to speak about, because that's the one sector where last 1.5 years have been major disappointment, primarily led by the drop in the input prices. And after China opening up, a lot of prices came down, inventory corrections happened, and in previous to China opening up, there was a lot of stockpiling up had happened. So as China opened up, the demand obviously slowed down because the inventory needed to be consumed. So you had volume kind of degrowth or low growth, and the input prices coming down. That kind of clouded the sector. But we think that this is the sector where it has a lot of potential. The short-term correction should not be taken as any judgment on the long-term potential of the sector. So this was but last 1.5 years period, and specifically last quarter, has been very painful for the chemical as a sector. Telecom, again, one sector where we continue to remain bullish. As we all know that ARPU has been going up continuously. In case of Bharti, it has gone from 146 rupees to 193 without any impact on the subscribers. That clearly shows the price inelasticity of the sector. And we all know that you are not going to switch your subscribers from 150 rupees to 200 rupees. And even if you switch, where is the other choice? I mean, it's a practically duopoly. So, you have only two and a half players market. So at best, you can go to, and all are more or less same. Some people have service issues, some people have liking to. So I think broadly speaking, attrition is not a problem, and I can see this ARPU environment continue to remain sort of positive. And especially if you see in telecom, Sunil Bharti Mittal, only made statement recently that in next few years, 25% of their subscribers will come from 5G, and 5G realizations are about 50% higher than the normal. So I think we are still beginning to see that cycle playing out. So telecom has a long way to go according to us, and which I think augurs very well for the earnings growth as well. So yeah, I mean, while I was referring to same out, I'll just probably I was sharing the outlook. So BFSI continues to remain robust, and we think that it has a long runway still because earnings growth, credit growth will continue to remain there. Sectors like insurance, sectors like mutual fund industry. So non-credit players have been going through some of the painful period over last few quarters, primarily led by some amount of regulatory changes, and that has kind of created some of the overhang on these segments, which we feel that will settle down. But we've kind of stayed away for most of the near term. But we will come back to some of those segments as and when they get interesting and growth comes back. But long term perspective, of course, potential is there. But once the short term pain over next few quarter gets over, that time we will relook at it. So far, our large part of the exposure is in credit in BFSI space. Non-credit, we will come back in some time. Auto ancillary, we continue to remain positive. Both on the domestic as well as export market. The momentum is likely to continue. Players like across the board, people are likely to do well. Players like Tata Motor are also very well placed, especially from an international market perspective as well. So I think we are in an interesting phase of sector where auto sector did not grow at all between 2015-16 to almost 2022, right? So 5-7 years of almost stagnant or no growth, and after that, so we're coming up from that kind of background, and it is no surprise to know that infrastructure has got better, economy has become bigger in the last 5-7 years. So the automobile demand obviously will be needed more. The automobiles will be needed more, and hence you will continue to see growth. Manufacturing is one sector we have continued to remain bullish for a long time and continue to remain. It's a once in a decadal opportunity. Our manufacturing GDP will double in the next 4-5 years, and especially led by import substitution and export orientation across automobiles, chemicals, capital goods, garmenting, defense, across various sort of value chain, consumer durables. So manufacturing is a very, very vast subject, and we see investment cycle has picked up. I don't know any company which has not been expanding their capacity in their own way. So this growth is obviously ahead of us, and we will continue to see this sector very well. Capital goods, order book accretion across the board has been very, very strong and solid. And many of the capital goods companies are exporting. Very often we think that India is only good at, we only import capital goods, but actually India also does a good amount of capital goods export. And investments in Middle East is a very, very big potentially opportunity for Indian capital goods company. That's also one of the trends we are picking up. So you are seeing that this trend will continue throughout 24. We don't see any challenge. In fact, sectors like chemicals, will continue to sort of do well with the low base and as the pain has gone behind. Pharmaceutical is the one sector which has been out of the sort of radar for most people because last 5-7 years earnings have gone nowhere, primarily led by the international business companies which have been having exposure towards US and developed markets. They have been having difficult times, because the pricing pressure was there. So most of the money they were making in domestic kind of was, a fairly large part of that was getting lost into international markets, or there was no growth coming in the international market. So pharma sector has been clouded, but we think that probably things are getting better. Pricing pressure in US is sort of bottoming out. Domestic market continues to remain robust, so there could be opportunity in that space to look at in some of the names, in this year. Specifically, I think next couple of years could be interesting, game changing for pharmaceutical. So net, I think overall we are seeing a reasonably good, robust earning environment across the board uh, for the Indian equities. Our estimate is that India should at least grow 15% kind of CAGR growth over till, and right now I'm just saying 25 because that's probably 2 years visibility. At least you can have it some degree of confidence. Of course, future things can change, but these are just a broader sense when you look at bottom up of each companies and try to do some estimates. So at least, and current year, from 24 perspective, I think 15 to 18% kind of broader range one can expect from earning growth perspective. We do not see much risk towards that, especially also when we are going to get into election year. A lot more spending happens in the economy, and that tends to even accelerate the economic growth and outlook. So I think that also is also one of the trigger for specifically for this year. So, very obvious question to ask, we are almost close to new high. So where are we in the earning cycle? And it is very interesting to know. And because ultimately, when you look at the history, you can kind of also try to get sense around where are we. And so it's corporate earning to GDP is a good sense of corporate profits as a percentage of GDP is a good measure to see where are we in the economic cycle. In the worst depressive cycles or the worst of the economic cycle, corporate profits to GDP is generally around 1.5%, and in the best of the periods, it goes anywhere between 6 to 8%, and that's the kind of broader range it has. And of course, we have hit 1.5% in 2001, in 2008, and in of course during the COVID time as well. So I think that is now recovered, and we are somewhere sort of close to 3.5-4% of the GDP in terms of profitability of the corporate profits GDP. So we have room to grow. So as GDP grows, so one is the GDP will grow, and then secondly, this ratio also should improve. So I think we have a room to grow as far as the corporate earnings is concerned. So we are not anywhere in a bubble kind of period for everybody's. So that it is probably we are in a sort of mid cycle or early from a corporate profit to GDP ratio perspective. That brings to the second point, which is liquidity. As we know that in short-term liquidity is what drives the market. In long-term earnings drive the market, but in short-term liquidity drives the market. And it's very interesting to get perspective on the liquidity. Where do we see that? And we are seeing, of course, good news is that FIIs are back, and we think that it's a beginning. And if all of you, if you remember, we had spoken about it in our last call also, and we had written a note on this about almost 6 months ago, that we see a massive liquidity cycle ahead of us. And the very logic and hypothesis is very simple, that whenever Fed raises interest rates, right, that's the time all international investors pull out money from the emerging market. It's a standard template they've been playing for 30, 40 years. And it's a simple logical thing to do because most emerging markets run current account deficit. So as Fed raises interest rates in emerging markets go up, their economic cycle goes down, and their asset class deliver negative return, currency delivers negative return. So when you know that that's happening, so people pull out money. This is what happened in last 2 years when massive amount of flow went from India, almost close to 45 to 50 billion dollar money went out of India. I can tell you from my, I've been in the market for 25 years. There was a time not long ago, 10 years ago, if FI sold $1 billion, market would panic and go down, 10% and, $1 billion. So we had no depth to absorb. And the good news is that in last 2 years, when there have been a 45 to 50 billion dollar outflow, India absorbed thanks to our, local money, which is there coming in form of SIP and otherwise also, right? Now, imagine what will happen. We have seen, so typically a point I was making, when the Fed raises interest rate, your money goes out. But when the Fed stops raising interest rate, it peaks out and starts coming down. That's the time flow comes back. And that is what we are precisely seeing. First sign of indication that Fed will not increase interest rates any further. We are starting seeing FI flows coming back. And that's what I'm talking about. And we feel this is a beginning because it is only a matter of time when Fed will start saying that we will cut rates. And as they cut rates, you will see the same amount of money coming back over the next 2 years. So I believe that what 40 billion we lost probably will come back or more will come back over next 2 years into India, because India, for two reasons. One is that interest rates are coming down, so that money will come. Secondly, India is one of the most promising market across the globe. Today, I don't see any market which can deliver, this kind of growth, governance, liquidity, sustainability, stability. I mean, there's no market of that kind in India, in the globe. So you will also get the market share, more wallet share from the investors. So I see a massive amount of flow coming from FIIs. Now combine this with the domestic money, because domestic money is not going anywhere, that is continuing. So that coming and FI coming, in my opinion, will be a massive, re-rating or massive liquidity flow towards India as a country, and we have to be ready for that. And that is where, if you have a question that where the markets are going in short term, my answer is here. You imagine earning growth is good, liquidity is coming. Frankly speaking, last 3 months, what has changed? Of course, earnings was better, but at the same time, it is only liquidity which is also driving it that better, right? I have seen this kind of outperformance earning when liquidity was not there. Market did not react at all positive to this kind of earnings growth. So ultimately, a good earning also need support from the liquidity. And if this good earning, there was no liquidity support, markets can also go down. So the point is, in short-term markets are always driven by the liquidity. So right now we are in a scenario where there's a good earning growth and there is a liquidity which is also supporting. And I see, in some sense, a fairly large amount of liquidity coming to India. Now, next question, obviously, very often we hear this question, India is very expensive. And I always say that, that's a very sort of disservice to investors. Anybody who advises that India, I don't think India is expensive at all. And on that also, we had made a presentation, in one of our quarterly earnings that, valuation is a function of, earnings growth and interest rates. And these three drives earning valuation. And on each of these three, India stands tall across the board, right? And that continues to remain. I mean, if you look at historical earnings on trailing basis, India is very much where it has been its average, right? So, and why a most promising market in the world should trade cheap? If it trades cheap, there's something problem with that, according to me. Then it cannot be most promising market. So why one expect India to trade cheap? It will not trade cheap. In fact, I will make a case that why it will get re-rated. So I feel that we have earnings growth. So assume that 15 to 18% kind of earning growth continues. If money which is coming, what I spoke about comes, what will happen? You are buying more stocks from the same money. So you will get re-rated. So India will get re-rated from here, driven by the liquidity. And that is a very, very important point all of us should understand. And the fact that India is also a low beta market. I mean, India is not, volatile, despite so much, sort of going around, uncertainty going around the world. India stands. We have had issues like Adani, we have had issues like SVB. But despite that, market didn't collapse, market had its own stability. So I think that tells you about the underlying resilience, strength of the market, right? So, and while we are, and while I think there's earning growth, but I was making a case for re-rating. So there's one more case, like I was saying, that I want to build perspective to you that how much interest rate drop impacts the valuation of the equity. We all know in case of fixed income that a 1% drop in the interest rates, if I'm buying a 10-year GSEC, which is a duration of 6 or 6.5, in price of the GSEC will go up by 6.5%, 6.5%. That we clearly know because we know the duration, right? This is so simple to understand in case of equity, in case of fixed income, because it has a predicted outline cash flow. But this is not so simply understood in case of equities. And that's what I thought we will kind of make a case for you to understand that a 1%, 2% drop in the interest rates, what kind of valuation it has impact on the equity. Everything else remaining same. I mean, let's say you are making a model, everything remains same, nothing changes. A 2% interest rate change will have a 36% impact on the valuation of equity. This is the kind of delta which it has. So like if I said, let's say, as you assuming interest rate drops by 2% from here. If your P is 15 times, or if your P is, let's say, 20 times, at 26 or 27 times, P is also fine, given the interest rates go down. It is at the same level. So interest rate has a huge impact on the equity valuation. This part is not very well intuitively understood. People understand, ऐसा होता है, but in terms of order of magnitude, people don't understand. So if you are beginning to see interest rates coming down, why would equity will be cheap? Why equity will not get more expensive? So my view is that given the fact we have earnings growth, we have the liquidity profile which is supporting, we have the interest rates environment which is expected to favor on down expected to go down, you will see equities remaining very, very robust. So this is our view. So I will just summarize that India looks good over short term, medium term, and long term. And I'm generally saying so that people know that our view is very sort of positive in a shorter term. We think that mid and small caps are real pot of opportunities, and one can make disproportionately large wealth in this period. And we are in one of the best wealth creation cycle. Risk reward is definitely favorable. Waiting for correction doesn't help. It may or may not come, that nobody can time, but risk reward is favorable clearly. Manufacturing and capex as a percent of GDP will continue to grow. We do not see any systemic risk as far as India is concerned. Even if something else happens somewhere else, we think the impact of that on India will be far lower because our integration on the global economy or our dependence on the global economy is far lower than it has ever been. Triple peaks have been made. Inflation, interest rates, and dollars have become peak. They are only expected to come down. Like I was saying, interest rates are coming down, and equity. When interest rates come down, of course, fixed income does well. But for the number I showed you, the impact of interest rates coming down on equity is disproportionately higher. Benefit is disproportionately higher. Hence, we believe that equity allocation should go up, and we expect India to re-rate further in times to come. So this is a summary on our view of our overall market environment. Of course, before I open to floor for the questions, let me also give summary into how we have done as a portfolio. We run about a few portfolios. I'll just give you a quick insights into each of this portfolio. So our Carnelian compounder fund, which is our flagship fund, which we started the firm with. It's a multi-cap fund with 55% large cap, 30% mid cap, 20% small cap. That fund, last month or last quarter was up 11.2% versus index of 8.4%. And of course, in CAGR also it outperformed the market by almost close to 5%. These returns are post our expenses. So you can see that. And if I can clearly show you another characteristics of this portfolio, because this is how we position our portfolio, that our portfolios are faster, stronger, and cheaper. So on revenue growth and earning growth, you can see on the screen that we are growing faster than the benchmark. Our return on equity is stronger. It is 18% versus benchmarks 14%. Our PEG ratio is 1.1 versus benchmarks of 1.2. Portfolio beta is 0.9. So we are basically taking lesser risk and outperforming the market. That is what essentially it tells. Now, our second strategy, what we call Carnelian shift strategy, which is, as most of you would know, that we started in 2020, 6 months after pandemic, which primarily focuses on two decadal structural change which is happening in India, namely manufacturing and technology. That strategy continues to do well. Last 3 months, the strategy is up almost close to 19% versus benchmark of 8.9%. Since inception also, it has delivered 41% CAGR versus benchmark of about 22%. And if I were to again give the characteristics of this strategy, faster, stronger, cheaper. Again, this strategy is revenue growth is 16% versus benchmark of 11%. Earning growth is 22% versus benchmark of 17.4%. ROE, stronger ROE is 18.4 versus 15%. PEG ratio is 1, and beta is 0.7. So again, in this, despite being small and mid cap strategy, the beta is 0.7, which again clearly speaks that we're taking lesser risk and outperforming. So this is our second strategy. Our third structural shift strategy, which we launched in form of AIF. Same, everything remains same except that, This is an AIF form. Of course, there is a little bit change. I mean, a lot of overlap of the stocks between the PMS and the AIF, but there are some differences also. This strategy we launched last year, April. So little over 1 year. In last one year, or since inception, this strategy has delivered about 26% return versus benchmark of 4%, or CAGR of 22% versus benchmark of 3.6%. So this has also done pretty well. And again, similar last year in January 22, we had launched this strategy called Yield and Growth, which was basically focusing on generating 4 to 5% dividend yield and 10 to 12% earning growth. That's the kind of investor. It's a concentrated strategy with 10 to 15%, 10 to 15 stocks. Again, if you look at this strategy also has done very well. We have delivered since inception 31% return versus benchmark of 8%. Since annualized return 22% versus benchmark of 6.2%. So this is how at least we've been performing on some of our strategy. So I think of course it's been a good period for us. There were some in between. We had a little bit of patch also, but I think these are the part of our journey. But we believe that we will continue to build our portfolio with a lot of care. As you know that fortunately we have not had any corporate governance issue in our portfolio. We have not had any so far in last 3-4 years of our history. We have never invested into any new tech. We have not invested. We have so far avoided most of the stupidities. Hope we continue to keep our sanity like that. But yeah, our attempt is to just stick to the core of our investing philosophy, which is focusing on risk management, and invest into high quality growth with a lot of focus on magic basket. So I will stop here and invite all of you to feel free to ask any question, any comment, suggestion. Welcome to have
Vikas, we have a question in chat from D. Sagar. Is there enough depth to the Indian equity markets to absorb all this liquidity? Seems like most of the liquidity chases a limited set of companies and not across the spectrum.
So, again, depth is a function. So if you see, depth is a function of opportunity, right? And since you asked this question, let me, address also. If you see between 2012-13 period to 2018-19, and there was a massive outperformance or overvaluation of a segment of a stocks which we started calling quality stocks, which was primarily basically FMCG stocks, consumer stocks with high ROE, ROC, no debt kind of thing, right? In that period, if you see, growth was very anemic. It was limited to only very few sectors. Banking was struggling, IT was struggling, capital goods was struggling. So most of the sectors in the economy was struggling because in 2013-14 we had economic shock of Fragile 5. Then new government came, but new government gave a shock in terms of demonetization, then GST, then ILFS crisis. So we had every year some or other shock. So we never had a sustainable, broad-based growth in that period. As a result of that, whatever money came, because money will always come as a part of the allocation, overall allocation, so went to those so-called quality stocks, and as a result of that, they became expensive. So when a lot of money goes into only few stocks or few segments, it becomes expensive. Very, very simplistic to understand, right? Same thing, so as post-pandemic, what has happened? Now we have seen a very wider base of growth. I was making presentation that banking is growing, IT is growing, auto is growing, capital goods is growing, manufacturing is growing. So there is in fact, consumer is the one which is sort of not growing as much, right? So you are seeing de-rating of those sectors. Money is moving from those sectors to other segments. So so that reallocation will happen. But India is now one of a very wide market to deploy capital. Having said that, if tomorrow, let's say, like $40 billion went away, if the $40 billion comes, in a short period of time, of course, water level goes up and everything will get re-rated. And I see a situation where, for the same reason I made the point that India will get re-rated because, another way to understand this is out of 100% equity India owns, India has, roughly about 60% is owned by the promoters. Okay, 20% is owned by the sort of FIs. and about 12 odd percent is owned by the domestic institutions, right? So you are about 92, 93%. So this is the broad breakup of the Indian equities. Now you have balance 7, 8% is owned by rest of the other participants. Now let's say if somebody wants to put more money, where is he going to buy from? If you want to buy $40 billion worth of stock, you have to buy from this 7, 8% only, right? So hence, incremental money coming in, if there's no lot of supply comes in, will lead to the re-rating the stock segments of the stocks in the market in general. So liquidity will, of course, will get absorbed, but it will, sort of in some sense re-rate the market.
I hope Sagar, it answers your question. We have another question from Rajesh Nair. Can you help understand for new deployment, is it good time right now for lump sum, or should we be cautious looking as per the recent run and deploying paths?
See, look, no, we've been saying for last 6, 8 months that keep deploying, keep deploying, keep deploying. What happens is that our confidence to deploy capital goes up only after market performs, right? And that's called recency bias in the behavioral finance. So we believe that what has recently happened has happened. But at the same time, I do believe, for the reasons which I outlined, that India is about to embark on a massive liquidity cycle. So I don't see major corrections coming through in the market. Of course, you can never predict short term what can happen. Anything can happen tomorrow. Some event develops in somewhere, and any knee-jerk reaction can happen. But normally speaking, I don't expect any sort of correction in the market. So as the liquidity comes in, I only see markets doing well from here. When market was, I remember in January or February this year, in one media interview, when market was, I think, around 17,500 or so, I said this year market will hit new high. And I continue to believe that market will hit new high. Now, whether it will happen, in 1 month, 2 months, 3 months, I have no idea, because that will really depend on a lot of other external factors. So I would say that if you're a long-term player, even if after investing market corrects 5%, how does it matter? I really don't bother about. If as an investor, I feel that if I have more money, I'll deploy more money. If it goes down, if it doesn't, I don't have money, I'll just sit tight. And if I'm a long-term investor, if I'm short-term investor, you need to time and you need to figure it out. But I would say that if you're a long-term investor, go for it.
Thank you, Vikas. I hope it answers your question, Rajesh. The second question is from Shamali Basu. Is too much money chasing small and mid caps? Do you have any concern on their valuations right
now? So, like I said, that still the liquidity is only begin. So everything will get re-rated. Small and mid caps will get further re-rated. There will be some point in time where we will have euphoria. We will have valuation bubble. I don't see right now. That's a part of the normal cycle. It happened. It has happened many times in the past. It will happen in future as well. So I don't see right now that it's a euphoria kind of phase. But of course, are they expensive than what they were 6 months ago? Obviously, the answer is yes. But one can keep waiting on the sideline. But one has to. One can't really do that. According to me, for the reasons again I just said multiple times, that I see liquidity remain very strong, earning growth remaining very strong. Hence, and very often, by the way, people ask this question. Nobody's asked, but I can say that what if the election outcome turns out to be bad? Now, again, I don't have an idea on that. As far as right now, it looks like that current government is going to come back. But if that happens, we can't take, like, a lot of FIs, by the way, who are not familiar with India, will see this as a big risk and probably postpone their deployment towards elections. Right now, if you want to come along with them after election, no problem. But by then you will be, again, if let's say outcome comes in the favor of the current government, then you will be buying far higher than what you are buying today. So ultimately the call has to be made. So we are very, very optimistic, very bullish, and we are not as concerned about the election outcome.
We have another question from Dhruv. Any thoughts on City Union Bank valuations? The FSI sector has done well, but CUB has one of the very few names that went the other direction. So, any thoughts on that?
So we, frankly speaking, we don't invest much in small banks. Not because we don't. City Union Bank is a good bank. In my previous role, I had interacted them with very very sort of closely. But frankly speaking, our liking for small banks is very very low because if I'm a the game has shifted in favor of some large banks. Their ability to, especially after the run on the few banks and time and again which have happened. So their ability to raise capital or garner deposit is always compromised. The ability to invest into technology to deliver experience and services to the customer is again compromised because their resources are limited. So they are always going to be playing second fiddle to the large banks, and hence, we have consistently stayed away from smaller bank. If at all we have invested, it is only opportunistically for when we find some 10, 20, 30% gains we would have done. But otherwise, by and large, our portfolios have been only in favor of large bank. ICICI Bank has remained our largest holding since the time we started actually, and it's done phenomenally well, right? Other bank which we took was Federal Bank, which was fifth largest private bank, and again, it's on a relative basis smaller, but much bigger than City Union Bank and also. While I have no recent update or I haven't tracked what's happening specifically in City Union banks for me to comment on it, so that I can only comment on a general category specific, but I don't have any, sorry, can't help you in terms of, as I don't have a qualified view on that.
Would request if anyone has any more questions, you can use the raise hand option or post any questions in the chat box.
I think a lot of people are asking views on the stock specific thing. I think I would, would avoid any of the stock specific comment because it can get really I think none of the stock which you mentioned we have exposure to. So my view or our view would be very generic and unresearched, which probably will be not so great. I can definitely comment on the sector specific. So, power sector looks interesting. Of course, in the renewable space, a lot of work is happening. But the power sector, the conventional power sector, of course, right now is out of flavor. Most of the sectors are from a dividend yield perspective, people have to invest. So we don't invest, and in power sector largely it is PSU dominated. Some of the private companies are there. Tata Power looks interesting, but we find so much comfort in the current set of segments and sectors we have invested. We feel the risk reward is out there, but I don't have a negative view. Auto banks very positive, like I said. It's one of the good phase going on. A, from a domestic demand perspective. B, from the demand on export side. Auto banks have been doing very well. We've been invested into many of them in the bearing space, even across the board actually. And most all of them have kind of done reasonably well. And we don't see that cycle changing anytime soon. Of course, there will be intermittent cycles and all those things you have to play out. But broadly speaking, directionally, we are positive. View on small and mid cap pharma sector. Pharma sector, I had given my view that I think it is looking interesting. Again, you can't in pharma also the stock specific is far more important because each stock has so much nuance. Whether you are a domestic player, you are international player, you are domestic come international player, or you are focusing on what particular, whether you are focusing on acute or you're focusing on chronic. So you really can't pass in judgment. But I think the in general judgment I can give or view I can give on pharma is the pressure. It seems that pressure on the US pricing is easing off. That can create delta on a lower base of the profitability. While there's no sign of reversal of the bad environment in US or Europe, but seems like it is bottoming out, and that's the reason I said that sector can do well, and 5-6 years sector has not done well. So one has to keep on radar, and specific companies have to be studied in the pharma sector.
So we have Shaurya asking us for a view on Heikel and Loris.
Yes. So I think these two stocks, of course, first of all, API in general, over last, I covered that again in my part of the chemical talk, that API in general throughout last 22 and early part of 23 has struggled. What had happened in 21 when there was entire supply chain disruption, most of the buyers had accumulated a lot of inventory because nobody knew when the inventory will come, and so a lot of people ordered. Of course, the consumption was not as keeping pace with the kind of inventory they had stocked. So there was an inventory pileup happened. Secondly, as the commodity prices came down, the price correction happened. So you had taken volume degrowth as well as the price correction loss. So margins went away, and that of course reflected because in 22. In 21, there was a euphoria which got built into APIs and chemicals, and stocks started trading at 40 times P, 50 times P. So that all has kind of sort of corrected. In case of players like Laura's, DV's, everything came down, right? I mean, on an average, stock was down from 50 to 60% from their peak, and we think that seems to have bottomed out. Things can only get better from here. In case of Heikel, there was a specific issue, as you all know that, or you know that there was an issue of the particular, accident of a few laborers who died, and then there was a court case, and unfortunately now then there's a family case happening. So that while business seems to be doing all right, that court case got settled, things came back, but again the family dispute came. But business numbers are all right. This quarterly number, if you see, they have done fairly well, and guiding also very well for the future. So let's see. We are monitoring very closely on that. Of course, there have been laggards, but we think that worst is behind.
So we have the other two questions. One is on your view on the real estate sector, like the companies seem to be posting good results. And the second question is, which is your top sector which you would give the best returns in the coming few months?
I think real estate looks good. Any economy which does well, real estate is a real sector. Which of course, if you have manufacturing picking up well, you need land, office space. If you have more employment, they will buy houses. So real estate is directly aligned to the economic growth. Unfortunately, last 10 years, economic growth was bad, and the sector was also going through its own pain because of the many issues like RERA implementation, ILFS crisis. All of them are behind. Demand is back, so I think the sector is expected to and set to do well. There's no doubt on that. So again, there you have to do your review or own work on the corporate governance, which to buy, not to buy. But sector in general is set to do well, and I think still it is massively underrepresented in the market cap of India, and which will change. Which sector do you think will perform well, will make money in the coming few months? Unfortunately, Manish, I can't help you with a few months because I don't have that short-term view of anything in life. I don't even know how to be very frank. If I knew, I would have told you. But from a sector performance, from medium-term to long-term perspective, I can say that banking will do well, manufacturing will do very, very well, IT will do well, capital goods will do well. Some of the, like we are right now increasing our exposure to some of the chemical names which we think that will do well. As right now nobody wants to touch them. Actually, good money is made when you have some insights contrary to the market insights, and that is where you can actually make a little more money. So we think that some of the names offer great opportunity from contract rate perspective. So that is where at least we are focusing. But yeah, they are all medium to long term. I might be completely wrong in next few months. In REITs and REITs, I think I don't know what is the question there, but yeah, there are good opportunities. That's a part of different asset class. So of course, in REITs, I mean, if you want to play real estate ownership game, REITs are a good game. In REITs are good yielding structures. So definitely interesting product depending on your portfolio asset allocation. Legal battle between Hiramat family and Baba Kalyani family will impact on. It might impact Haikel. I mean, currently company's performance is doing well. So our view is that right now Baba Kalyani is wanting to buy more stocks of Haikel. And if he succeeds, he will buy more, and that can only be better for the stock as long as the business is doing well. So right now business is doing very well. We are monitoring very closely. Having said that, it won't impact much Carnelian performance because it's not a very large position for us. If it happens, we think that business has deteriorated or some ugly turn is taking which is impacting the company, we will get out of it. And we don't have as large position that we can't get out without impacting market. So we will do that. I think Viraj, probably there are no more questions. Are there any more questions, Viraj?
Just one from Tarun in terms of auto components. I think you've covered earlier in terms of.
I have covered auto components.
Yeah, and Sumit asking about Birlasoft, but I think IT is also covered as a whole.
Birlasoft, I think I have covered. I think Sumit is asking, right? So I think Birlasoft, I think we had, the stock got hammered in the last years of, IT hammering, so to say. And there also we had a situation where the CEO left, a new guy has come. He looks to be promising, and we are seeing, things coming back. They also had a bit of a write-off, which also impacted. Those kind of things can happen when there was a bankruptcy in US. So one of the large clients got bankrupted, and because of that, they had to take a knock on their profitability in a quarter. I think 20 million or something, which is a large amount for them. So I think we are right now invested in the stock. We think that the guy who's come from Wipro handled large portfolio. He has potential to kind of change company's trajectory. So, and in general, environment for IT mid-caps is looking good. So we are holding on right now, and if anything changes, positive or negative, we will react on that. But right now, we are kind of continuing.
We have another question in the chat box from Ajay. Whether in the shift strategy, whether the PMS platform or the AIF platform, which would you suggest to invest in?
So I think PMS platform is both are kind of pretty much same. The theme is pretty much same. The only difference in AIF is that we have two things. One is that we end up doing slightly smaller companies in AIF because it's a long-term 5-year capital, so it gives us a little bit more peace of mind when we invest into smaller companies because we don't have to worry as much about the liquidity as long as we like the business and management. And secondly, we also do up to 30% of the fund can invest into pre-IPO companies in this space. So we just concluded one transaction in a data analytics company, which is going to go public in next 12 to 18 months. We have invested at around 18 times P, whereas the listed players are trading at 40-45 times P, and growth will come. So I mean, these are the kind of situations where we can find good, interesting companies which will go public over next 12 to 18 months. We can invest into that. So that gives slightly extra return. So and we are neutral to it. But if anybody asks my personal view, I think, and it has a little bit more long-term view about life, I think AI could do better. But investing style, theme, everything remains same.
If anyone has any more questions, there's a question from Manish Vikas.
If interest rate will decrease in coming month, which will increase the intrinsic value of the company, makes the stock cheap. I think Manish, probably you joined late or you missed my, presentation where I made this whole point that, when interest rates are coming down, the market will get re-rated, the P will increase. So I think I made a very whole section in the presentation where why P will get re-rated for India in general. Sure, Sumit. This we'll chat. We'll chat.
If anyone has any more questions, feel free to raise your hand or drop a question in the chat box.
Well, I think again, Vidar, I guess no more questions. So thank you very much, everyone, for joining us this afternoon. Like I said, that I always enjoy interacting with all of you. So do let us know. Do write us back if you need any more information. If you want to ask any questions, please feel free to reach out to us. And thank you, Tanay, Viraj, for putting this together. Thank you.
Thank you, everyone.